Welcome to our video on absolute return. Today, we'll explore this exciting investment strategy, its applications, and how it stands out from relative return strategies. First, let's define absolute return. Absolute return aims to achieve a positive return, regardless of market conditions. Unlike relative return, which benchmarks performance against an index, absolute return focuses solely on achieving gains. For instance, if you have an investment that yielded 5% return regardless of whether the market went up or down, that's an absolute return. It is fundamentally different from relative return, which might measure how well you did compared to the S&P 500. Let's see an example. Consider two funds, Fund A and Fund B. Fund A focuses on absolute return strategies and gains 3% when the market index falls by 2%. Fund B rewards its manager on relative performance compared to the same index, gaining 4% when the index rises by 6%. You might wonder why investors choose absolute return. Here are some benefits. Number 1. Absolute return strategies can offer a hedge in volatile markets. Strategies often include a mix of equities, bonds, derivatives, and alternative investments to balance risk. For example, a hedge fund might use futures contracts to hedge against market downturns while investing in stocks they believe will outperform, combining different strategies to achieve positive returns. Another advantage is reduced correlation with traditional markets. This means your investment isn't tied directly to market movements, helping in diversification. Now, let's dive into some advanced concepts within absolute return strategies. Alpha and beta are two key metrics. Alpha represents the strategy's ability to beat the market, while beta measures the sensitivity of returns to overall market movements. In absolute return funds, a positive alpha and low beta are sought after. Consider a scenario where Fund X has an alpha of 3% and a beta of 0.5. This means it performs well independently of market changes and adds genuine value over market benchmarks. Additionally, Sharpe ratio is a key metric. It measures the risk-adjusted return. A higher Sharpe ratio indicates better returns for the risk taken. Let's say two funds have the following data. Fund C, return 8%, risk-free rate 2%, standard deviation 5%. Fund D, return 10%, standard deviation 8%. Fund C Sharpe ratio equals 8 to 2/5 equals 1.2. Fund D Sharpe ratio equals 10 to 2/8 equals 1. In this case, despite Fund D having higher returns, Fund C is more efficient considering the risk taken. Let's discuss some common strategies within absolute return approaches. Number 1. Long/short equity. This involves taking long positions, buying, on undervalued stocks and short positions, selling, on overvalued stocks. For example, if an investor believes tech company A will outperform tech company B, they might go long on A and short on B. Another strategy includes market neutral. These funds aim to isolate alpha while offsetting market exposure, maintaining a balanced long and short position for a beta close to 0. For instance, Market neutral Fund Y might hold $100 million long in stocks and $100 million short, effectively nullifying market movements and purely focusing on stock selection for returns. Lastly, let's validate your understanding with a few questions. Question 1. What is the primary goal of absolute return strategies? Maximize returns regardless of market conditions. B. Achieve higher returns than a specific index. C. Minimize exposure to risk. D. None of the above. Answer: maximize returns regardless of market conditions. Absolute return strategies aim to generate positive returns in any market condition. Question 2. Which metric measures risk-adjusted return? A. Alpha. B. Beta. C. Sharpe ratio. D. None of the above. Answer: C. Sharpe ratio. The Sharpe ratio measures risk-adjusted return, providing insight into the efficiency of the returns in relation to risk taken. Question 3. If a fund has an alpha of 2% and a beta of 1.2, what does this imply? A. It has a strategy independent of the market. B. It has higher risk with moderate returns. C. It performs well relative to the market with more volatility. D. None of the above. Answer: C. It performs well relative to the market with more volatility. The positive alpha indicates good performance, whereas the beta greater than 1 suggests higher sensitivity to market movements. To conclude, absolute return strategies are powerful tools in an investor's arsenal. They offer potential gains across market conditions and diversify risks. Remember to consult a financial advisor to understand how these strategies fit into your investment goals. Thanks for watching and happy investing.